Well, joining me now to tell us more about how the futures market for commodities works is Tom James. He's the regional manager for Asia Pacific with Credit Lyonnais Rose Derivatives here in Singapore. Tom, good to have you on. Thanks for joining us today. Now, commodities, especially commodity futures or derivatives, not very well known, not very well understood, still pretty obscure. But I mean, obviously they have been around for some time now. Why this lack of understanding?
I think the lack of understanding certainly in the Asian region has come about as the key markets have developed initially out of Europe and then America. It's only been last 10, 20 years that we've seen these sort of markets developing here in Asia. So it's relatively very new.
Okay, is it a question also of money? I mean, when people talk or think about trading commodities futures, usually quite large sums that come to mind.
Yes, I mean, the futures markets, because they are perhaps more volatile than stock markets on a daily basis, it does involve large capital. So that's also kept a lot of the smaller investors out.
How much of it is also due to either, I guess, awareness, perception, or even education? I mean, do people here, do many people here really know what commodities futures is all about?
Probably not. I mean, probably the first point is that natural resources in the region are quite scarce, quite widely spread out. So we've seen only limited number of commodity exchanges actually developing. Some in Malaysia, some tried to happen in China but were quickly closed down, and they're probably the most successful in the region, Tokyo, and some here in Singapore on the commodity side. Perception, yes, I think education. People are not fully aware of how to use them, so they're pretty nervous about getting involved in them. Also, the fact of regulation as well, because people, certainly companies in the region, haven't really been able to promote them to retail customers because of the lack of regulation, not because of regulation. It's only been perhaps the last couple of years, 1 or 2 years, that we've actually started to see the capital markets, the regulation, the legal framework actually being set up in the Asia-Pacific region to allow fund management companies, advisors, brokers to actually promote this to retail customers.
Okay, retail customers, I'm just curious here, I mean, even in the West where it has been quite well developed, I mean, is it really the small players that move the market or not?
Well, looking in America, there's certainly a large portion of retail customers, the sort of professional, just accountants, doctors, dentists, taxi drivers even, who are just trading the markets. But that's probably because there is a better level of education and availability of information. And certainly for the smaller investor out here, time zones is the biggest headache. With 13 hours difference between you and New York, and the other biggest commodity exchange being the Chicago exchange, you're looking at 17 hours time difference. It's a real headache to actually monitor those very volatile markets effectively.
You have to be willing to change your lifestyle, live like a vampire for a while to make money then.
Yes, a little bit, yes, yes.
Okay, what are the prospects for futures markets for commodities developing here in Asia? What are the prospects, for example, of governments? I mean, how keen or interested are they in developing these markets further?
I think they're very keen. I mean, even in Singapore, Malaysia, this region in Southeast Asia, you see many exchanges linking up with foreign exchanges so that they can start trading locally here in this time zone very well regulated, very well liquid and tradable contracts. So we're seeing some contracts being brought over here and certainly some new ones being developed.
Okay, I mean, at this point, which is probably the most advanced or progressive market for commodity futures in this part of the world?
In this part of the world, you've got, out of Tokyo, you have rubber futures, which has been amongst the top 20 traded for many years, for many industries. You have metals such as copper, which is very volatile but very well traded. And also the energy markets as well, which brings a lot of opportunities, is also traded here. Cymex as well did a link up with the International Petroleum Exchange in London, brought their contract here in Singapore to be traded in the local time zone here.
Okay, I'm just wondering, over the last few months we have seen tremendous financial turmoil in this part of the world, making stocks look very, if not, I mean, cheap definitely, but very risky. Currencies as well. Do you think this could perhaps push, give more impetus or give commodity futures trading a push as an alternative?
It should be. I mean, both for the larger investor who may be looking at protecting themselves against inflation. If inflation goes up, that's usually linked to general raw materials, commodities going up. And also just as an investment, probably now the stock markets don't look very attractive. People are not uncertain as to how things will develop, but people still need to consume materials. People still need commodities. They may not need the stock market, but there'll always be some trend, some predictable trend movement in commodity markets. So we may see some more money going there.
Okay, predictable trend movements, but I mean, the general sort of feeling is that trading commodity futures is much more volatile even than stocks or FX.
That probably comes about from the gearing. You know, in the stock markets here in Asia, we've seen various huge amounts of volatility, 5–10% even more at times in recent months, years. But commodities, you may only see a 3 or 4% price movement, but we have what's called gearing. Basically, to trade the futures market, you may only actually have to deposit a fraction of the amount of money that you're actually able to trade. So say you have a contract of oil, say for instance, which is worth $50,000 US, you may only actually have to deposit $5,000 with your broker.
10% goodness.
10%. So if the actual price moves up 4 or 5%, that's for you, in your perception, that's like a 40–50% move.
Sure. Okay.
I mean, that works both ways.
What if it moves down, though? Ah.
Yes, works both ways. So gearing can be your best friend and your greatest enemy. So that's one thing which has to be understood. And before a customer, a retail person can get involved in the futures market, they must ensure that they can either, you know, stay awake at night time to cover the foreign markets or have a good broker to watch it for them.
Sure. Okay. Now, 50,000 you mentioned oil contract. I mean, is that roughly the minimum amount we're talking about, or are there sort of smaller contracts or lots as well?
Well, I think most financial institutions, if they're looking to take on a retail customer, they'll usually go through the financial status of that customer, that person or individual. And the general rule is that they look at the overall monies immediately available, what you can take out of bonds, out of stocks, and get as ready cash, and take 10% of that. That's your risk capital. And then you then take that and then put that into the futures market. So it's a small amount of money. So you have to be worth a reasonable amount of money before you can really start to trade the market.
Because of the leveraging of the gearing.
That's right.
Interesting points. Okay, Tom, we'll have to take a break now. We'll pick up on some of those points in just a second. When we come back in the second half of our show, there is a price to pay for the energy we use, and that price could soon be going up. When Money Talks returns, we'll have more.
You can read about Money Talks in every other issue of Asia magazine.